Today is our kickoff of our first series of events we are calling Lunch and Learns. The idea for this series is to have Zoom meetings, but opportunities for people to come in and really dig in deep into a topic. We're encouraging people to have their computers up, and we're going to go through things to do work together. And I think cash flow is definitely one of those things that you really need to roll up your sleeves and do work to get your arms around. I can tell you about how to do it, but you're not going to manage it until you start looking at your own numbers and working through a spreadsheet. We're going to go through how to do that today. You have myself and Bonnie are here. I have been with SBDC now, I guess, 5 years, which is crazy. Prior to that, I spent the majority of my career in financial services. I was in what they call the buy side. I worked in investment banking and private equity. And then I was a sell side analyst for a while. I've done a lot of work in different areas of financial services. And what that means for a small business owner is that I have read a lot of small business plans. I've helped build them, and I've helped build a lot of financial models to help startup companies get investment. I'm here to help you understand your finances and really encourage you to embrace them as a small business owner. And, really the most important thing of finance is cash flow. Cash is king, as they say. That's what we're going to go through today. We're going to talk about the cash flow cycle. And what that means is basically how cash comes in and out of your business. It's kind of a living and breathing thing. You need to follow the dollar of how it works its way through your business. We're going to talk about cash flow projections. A lot of our clients have cash flow issues, and everybody has to understand cash flow. And really, the only way to do that effectively is to plan for it. We're going to give you tools today of how to do that. And then once you have your cash flow plan, we're going to go through strategies of how to improve it. There are definite tools and levers that you can pull to improve your cash flow. Our goal for the next 90 minutes is one, I'm going to really stress with you to be committed to embrace your role as the CFO, as the leader of your small business. We're going to provide clarity around the difference between profit versus cash. We're going to go through tools to build a working cash flow model. Again, you're never going to be able to manage your cash unless you project it. That's kind of the eat your vegetables comment of the day. Like, you need to get a spreadsheet down and work through it. And then the action we want you to leave with is to find one way to improve your cash flow. I'm going to show you many, many ways that you can try to do that, but we want everybody here to at least commit to at least one method of trying to improve their cash flow. To start with, our first learning goal of the day is, commitment, embrace your role as a CFO. I love this little cartoon here where Lucy is asking Snoopy, I've always wondered why you decided to be a dog. And he says, I was fooled by the job description. And I think that is the plight of many small business owners, where you think, oh, this is going to be fabulous to work for myself. Well, in many cases, we're fooled by the job description because there are lots of things that come along with that territory that people don't love to do. And one of those we find time and time again is financials. If you look at the role of a small business owner, interestingly, I did a Google AI search of describe the role of a small business owner, and I will give you the summary. You don't need to read all this text. The take-home message is that nobody really fully appreciates how crucial it is as a small business owner to be involved in financial planning and analysis. So basically, the forecasting of your numbers. Your accountant will do bookkeeping and taxes and retrospective analysis, but very, very few accountants will do projections for you, and those that do will certainly charge you accordingly. That's a tool that you really need to embrace, and a skill set that you need to embrace. And if we leave here today convincing you of that, I will feel like I have done my job. Just you, as a CFO or as a small business owner, you wear many hats. You're the CEO, the COO, you're in charge of HR, you're in charge of marketing. Well, you're the CFO of your business. And again, just to stress this more, many people think that they are not that because they have an accountant. Just because you have an accountant and a bookkeeper does not mean that you do not and should not worry about looking at your financial forecasting. Don't let that be too daunting to you. We are here to help you through that. and it's not as intimidating as it may. If you don't have a CFO, you are it. To move us along to the path to embracing our CFO status, we need to do a little bit of a self-assessment. What I would like everybody to do is just kind of take an assessment for themselves. You can do this mentally or throw it in the chat if you like. How comfortable are you with your numbers? How often do you review them? What kind of reports do you get from your accountant if you have one? If you don't have an accountant, who's managing your books? Who's managing the money, the collections, how you get paid? Really take a good assessment of how are you tracking that? Are you using a spreadsheet? Are you using accounting? Using bookkeeping? Figure out where you are, and then we can help you understand how you can build to become better, because there's always a room for improvement. And really the largest why businesses fail, and one of the largest that they succeed, is really how well are they managing their finances. And again, that's not accounting, it's really projecting, understanding money flow, and understanding how it's being put to work within your business. One key misunderstanding when it comes to financial management is many people confuse profit with cash. Profit is not the same as cash. You can have a very, very profitable business on paper that is very cash poor and on the verge of bankruptcy. Just because businesses that are low on cash aren't necessarily bad businesses or failing businesses. They're just poorly managed from a cash flow perspective. You can have a great business and just not have the cash on hand that you need. Why is profit not cash? And for businesses, it is the same, but for most, it's not. And the main why profit does not equal cash flow are non-cash expenses. If you do your profit and loss or income statement that your accountant or bookkeeper will put together, you can depreciate things. You can depreciate your house. You can depreciate property and equipment. You can depreciate a truck that you may have in the business, and that will lower your profit. But it does in a non-cash way, because depreciation is a non-cash expense. It's really just an accounting number that basically says this truck that I'm using is going to be worth less and less over time. And then that lowers your profit because you're allowed to take that as an quote unquote expense, but it's not a cash expense. In that case, you actually have more cash than you do profit. And then there's timing of payment. You may have a ton of cash coming, but if the cash coming in the door does not line up in terms of timing with the payments that have to go out the door, you have a problem. Like, you might be able to get, $1 million in a month, but if you owe $500,000 right now, you've got a problem, right? You can easily pay it, but timing is everything. That's really where this mismatch comes in with cash flow versus profit. Basically, what our cash flow statement does is it takes into account what are actual cash inflows and cash outflows. Many business owners are very familiar with the profit and loss or income statement. This is the typical thing that your accountant will give you, or you just look on paper. I have much in sales. I have to pay my cost of goods, whatever that is, to create my sales. Say I run a food truck, my revenue comes in for the sandwiches I sell. My cost of goods is anything that I bought to create those sandwiches. And then I have operating expenses. I have to pay for the truck and the fuel and insurance. And then what's left after that is net profit. So this is how your profit and loss or income, which is they're synonymous, it's the same thing. That's how that works. Now, the cash flow statement is different. And that basically, the cash flow statement shows you where cash is coming in the business, where it's going, and what's left over. There are and uses of cash. We have really three different types of cash flow. The first is obvious. It's what is the cash coming in the business from sales, right? It's a day-to-day indicator of health. How much cash are you getting for whatever your profit or whatever your product or service is? The cash coming in is what you're getting paid for. Now, the timing of that, as we talked about earlier, varies, because you might get paid in cash, you might get paid by credit card, and then you've got to maybe wait for that to hit your account. Or you have to invoice people and then you have to wait for them to pay you. The nature of your business and the nature of how you're paid really affects your operating cash flow. Your other source of cash is investing cash flow. And what that means is what investments are you making into the business, what buying and selling of assets or equipment. And you would consider, it might not be intuitive, but if you purchase, say, in the case of the food truck business, we bought a new second food truck, that outgoing cash to buy all that equipment would be considered investing cash flow. You're investing in the assets to grow your business in a future date, right? And then you have financing cash flow, which basically comes from loan or debt or money that you put into your business. So there's difference of cash. Operating cash is our favorite. That's the one that we would like to generate the most of. Does anybody have any questions on that? Okay, I don't see anything in the chat. Maybe keep an eye on it if you say, okay, perfect. We need to understand our cash flow cycle. Just sit back and kind of think about, okay, where follow a dollar through your business. I need to buy inventory. Cash goes out to buy goods and services. Then I make a sale. Cash comes in when when the goods or services are. There's timing with that, as we talked about. Whether you're paid in cash, whether you have to invoice. If you're in a healthcare business, you might wait 6 months to get paid. There's this receivable collection time, and most people are paid in different. It's a mix, right? You don't get maybe some of your sales are cash up front, as credit and as PO, depending on what you sell. Then your cash realization is when that cash finally comes back into the business. So you need to just understand this like cycle, and it's not different than just from a perspective, like maybe if you have a salaried job, you're paid once a month or twice a month, then that's when money comes in. You need to think about, how does that money coming in align with the bill timing of the bills that I have to pay going out, right? Maybe all your credit card and your mortgage and your kids' tuition, et cetera, it might be due all on the 5th of the month, but you get paid on the 1st and the 15th. You need to think about, my bills are very front loaded. My cash coming in is smoothed out over the month. Cash flow in a business is no different than that. It's as simple as that. There's more moving parts than we see typically on a finance thing, but it's the same idea. It's nothing more than timing of money coming in and money coming out. Why is cash king? As I mentioned before, you might have a really successful business that has great sales, but they might be really cash poor, strapped. Why is that a bad thing, right? Businesses need cash to survive. It provides them flexibility to make decisions. If a business wanted to purchase new equipment, if they maybe have the long-term profitability, but not the near-term cash to do that, then that's going to stunt their growth. If you don't have cash reserves, you're not able to weather a bad storm, for the pun. We have a lot of, obviously, and the key, cash is particularly important for businesses here because we have, freak things like hurricanes, and then we're very tied to weather and tourism for the most part. You never can truly have a crystal ball to project what those things are going to look like. Having cash reserves on hand really helps you deal with unexpected downturns. And cash provides sustainability. You get continuous flow, ensures that the business isn't dependent on constant borrowing. You don't have to oh my gosh, I need to turn around right now and run to my banker and try to get money for knocking at the door here. Forgive the interruption. Okay, that's kind of the groundwork for understanding cash flow. Hi. If you want to join into the Zoom link, we just have join in. If you want to join into the Zoom link, but if you can turn off both in and out, otherwise we'll get feedback. What we really want to work on today is our cash flow roadmap. I will give you an overview of this, and then you can scan this QR code to bring up the Google spreadsheet that I have built. And I would ask you, if you open that, if you can just make a copy of it, and then you're welcome to play with it as we work through examples. If anybody has any issues with that QR code, let me know, and we can just, I guess, email you or text you the link directly. You really need to, as I stressed in the beginning, there's no two ways around it. If you want to really manage your cash flow and take away the stress of that kind of hanging over your head, you're going to have to sit down and do projections. The first move here is to sketch your year. Which months are your bread and butter months, which are lean? Busy months often have to fund your slow months. It's not just today's bills, but slow stability. When is peak tourism for you? Should you have an extra buffer in for hurricane? Are there any other patterns unique to your business that you need to be mindful of? I mean, I think everybody that has businesses down here knows when things are good and when they're likely to be slow. And there's usually a pretty big delta between those two things. Think about that. You're aware of it, I'm certain. But what we see often is that even though clients are aware of it, they aren't always planning for that proactively. Why does this matter? You can't fix what you don't see. Your pattern is your roadmap. You need to do a little bit of homework to figure out, what does your pattern look like? How does that line up with your expenses? And then how do you plan for that? You want to build your 13-week forecast. Why 13 weeks? 13 weeks is basically a quarter. And this is a very standard industry practice IBM has a 13-week forecast. Like this is typically what businesses frequently do to look at cash flow. And it's a simple spreadsheet. It tracks starting cash, what comes in the business, what goes out of the business, and what on a week by week basis. You don't necessarily need to do it week by week. It really depends on the nature of your business. Restaurants, we probably want to do that week by week. You need to understand, like, how often do you need to pay bills, and what the weekly is good because it doesn't mount up and you aren't left with like, oh gosh, I need 3 months of catching up. And you stay on top of it. You're more alert as to any cash flow crunches that you might have. And then, there's things like theft that might not show up, or just change it. Maybe you changed inventory and the new stuff that you thought was going to sell really well is not. And it's kind of a leading indicator too of maybe there's wrong. If you can manage to do it on a weekly basis, great. Again, you don't have to. That's kind of can be tailored to the nature of your business. Since you're mostly credit card payments, I think most businesses here are credit card payments. You need to focus on, okay, what are my fixed expenses? What are my variable costs? And how much do I want to, pay myself? I'm going to switch over to the spreadsheet here just to show you this if you haven't pulled it up on your own. Hold on, I'm just going to resize this a little bit. I can see it. Okay. This is, okay, you got it. Okay, just a second. Okay, we're good? All right. This is a Google sheet. I have Excel sheets created. If anyone prefers to work in Excel, I'm happy to send this as an Excel version. You can probably download it into Excel. I have things that are more robust if this is a little too training wheelsy for you. But at the end of the day, it's all the same thing: cash in, cash out, cash left over. It's as simple as that. How this starts out is we have a monthly tracker. And as I said, you have, cash in, cash out. Now, the cash out is generally the easier part, right? Like most of your expenses are probably fixed, right? You know what your rent is. You're going to know what like equipment might change. You might need to buy a lot of equipment at the beginning of the summer like that. That might be a little bit more variable. Payroll will kind of ebb and flow most likely with revenue. Your cost of goods will go up and down with revenue. The expenses aren't really the hardest part. Taxes is one that people forget to budget for, right? Because you need to pay that typically quarterly for small businesses, but your situation may be different where you have to pay it annually. That needs to be accounted for. This will be easy. It'll be a bit more guesswork. You can look at what has happened in the past and project forward. And again, we can help you work through that if it's a little bit daunting, but just kind of go line by line. You don't necessarily need to include, you don't have to get too crazy granular and have every little expense. If you think, my costs are typically $500 a month for all the subscriptions that I have and Word and AI, what have you, throw that in there. Again, you don't have to get too crazy granular. It will depend on your business. The thing that I find clients have more trouble with is really forecasting revenue. You'll need to forecast your sales, and then you'll need to understand what percentage of those sales are coming to me in cash and what percentage of them am I getting paid for later. That can be, again, depending on the nature of your business, that can be really straightforward. I run a charter business and I go out with people and I get paid right away, right? I find that that's simple. I am usually on the water this many, 100 days a year and I get $1,000 a day. This is my revenue. That's not tough to forecast, right? But again, every business is different. If yours is more complicated, we are happy to help you think that through. And then once you have this laid out, this is all built to kind of do the math for you, and you'll see, how much cash you have left over. There's scenario testing in here. You can say, what if my revenue went down by 10%? What if I had an unexpected expense? My truck broke down and I have to pay, $5,000 for a new transmission. I did not see that coming. What happens under those sort of scenarios? Again, this is all just forward best guessing and planning. And then if you feel like you have places where, gosh, I might be running low on cash, how do I mitigate that? How do I, do I keep a credit card that I don't use in the events of emergency? If I have the ability to leave, cash in the bank, or do I get a revolver, a line of credit? There's different tools depending on the kind of the nature of the business, the nature of the amount of cash you could possibly need. Again, the more proactive you can be, the better. When things happen that are unanticipated, you're prepared. This gives you a weekly snapshot. I've put in here just kind of dummy data. You can see how things flow. I have, if you want to take a little bit more robust, I'm happy to share this. This is a revenue model I built for this fictitious business called Flip Flop Photos. And I projected the revenue based on, it was a photo booth company. What's the cost of the photo booth? How many photo booths are they likely anticipated to sell? And what are my cash collections going to look like, right? And then from there, you can go to your cash flow. I know I have this much in cash receipts. I might have larger events that I do for hotels, and they pay me half up front, and then they pay me half 30 days later after the event. You need to think about, again, how does that cash coming in? And this is really about the timing. It can be a little tricky to forecast at first, but again, once you look at what has happened in the past, and again, we're happy to help you work through it and get it, into a spreadsheet, into a workable format for you. And then once you kind of do the heavy lifting to get that set up, it should be much easier going forward. I have those two that I can share with you, and you should be able to get with that QR code. Again, you're welcome to email me or Bonnie if you'd like the Excel version. I can send that out as well. I would like for people to start tinkering with that. If you already have one, fabulous. This is what it should look like with the data filled in, right? You've got your total revenue receipts, how much other income you might have, what's going out, and then what's left over. And then what's left over in the end of January becomes the beginning cash balance for February. And you just keep doing this cycle throughout each week to understand. Once you know this, how do you improve your cash flow? There's several levers that you can pull. You can time your expenses. You can push big vendor payments out into your busy months. Say that you have to pay a big insurance bill for the year, for example. Maybe you can talk to your agent and say, hey, listen, this big bill comes due in May, and May is horrible for me. Is there any way that we can do to shift that payment into a month where I don't have this cash crunch, right? Credit cards will let you change the date of the bill pay. You have to say, like, listen, I pay you on the 2nd of every month. I'd really rather pay you on the 27th. Can we move that? And they'll do that. you just kind of think logically of how can I time my expenses. Then you want to think about fixed versus variable costs. Fixed costs are like rent, right? Your rent is your rent is your rent. Variable costs often change with revenue. In the case of our sandwich shop, obviously you're selling more sandwiches, you're buying more bread. Those expenses kind of nicely go up and down with revenue. They become less if you're not making as much money, you're not needing to buy as much cost of goods for those sandwiches, and potentially, your labor is lower as well. Think about, are there any fixed costs that I can convert to variable costs, or are there big expenses that I can smooth out and pay over multiple months? For example, maybe you have an insurance payment in that example before. They'll let you divide it up into a quarterly payment. They'll charge you a little bit of fee to do that, but it's cheaper in the long run than having to pay it all when you can't afford it, and it needs to go on a credit card and then you have to pay that down. Just think about how you can manage the timing of those particular expenses. The other levers that you can build is, build reserves, calculate 1 month of must pay bills. Like, what is your quote unquote, what's the nut you have to cover, right? You know that I have to come up with this much money to break even every month. I can make sure I'm paying my bills. What is that number? I think a lot of companies, they don't even know what that number is. And then drive the amount of reserves that you have off of that number. Just say, hey, listen, I don't know what might happen, crazy pandemic kind of scenario, and I want to have at least 1 month, 2 months, 3 months in my kitty for comfort. And again, that's, obviously it's good to have it there. Do this in a rational way. You understand, like, what's a good number? What's a number to set aside, and see if you can get there. Pricing and other offers, slight price increases before peak packages, prepaid bundles, pull cash forward. If you can incentivize people to pay you now rather than later, money now is always better than money later, unless you're getting paid to wait, unless you add, extra interest on a delayed payment. Think about, is there a way that I can get more cash up front for what I'm selling? I think I was going to do a scenario together, but that's really hard to do with most of the folks on Zoom. That logic is built into that spreadsheet. I think just tinker with it, and then as I said, let us know if we can be of assistance. For your action plan, in addition to trying to, taking a stab at setting up your 13-week forecast, I would like you to identify your top 3 red flag weeks you'll watch this year. When do you kind of know that things for your business, and I assume 99% of our businesses down here have particular weeks that are challenging? What are those weeks? What do you need to be aware of, and how can you more proactively plan for those? And then commit to a habit of checking your cash flow, right? And it's not really, I think if you can log in and look at your bank account balance, that's one thing, but it's good to know, and it's certainly good to watch, but it's really good to understand what's coming in and what's going out, and what is the timing that's affecting that bottom line bank balance. And then make 2 commitments, one slow expense change and one busy reserve rule. Think about, how can I maybe behave differently in my on versus my off to improve my cash flow, because those, for many businesses, those 2 times of the year look especially different. This case study, flip-flop photos, is what I've shown you already with the spreadsheet example. Okay, cash flow conundrums, common mistakes that people make are overestimating cash availability. Many businesses kind of assume profit equals cash, and then that leads to overspending and poor decisions, right? You think, oh, I'm going to sell this many things, but I'm not accounting for potential returns, right? Actually, that probably should be in that spreadsheet. Cash is coming in, but cash might have to go out too, or it should be considered kind of an expense where I might have to pay for refunds, pay for shipping back, give people money back that weren't happy with the service. That thing needs to be accounted for. And a lot of people kind of don't don't estimate that either. Assuming profit equals cash is a pitfall, right? I think I see a lot of times where you have cash flow issues. You're looking at what the accountant's giving you, and you feel okay, and you're not planning for the big tax bill that's due in 3 months, or the big investment that you need to make in new equipment, or the big insurance bill that you need to pay. Again, that's just really lack of planning and forecasting. Delayed payments. The sales on credit look profitable, but don't add real cash until collected. Maybe you made a sale online, but that money isn't in your hot little hands yet. And you're paying, you're spending it already, but you haven't been paid. And then focusing on profit only, and you ignore this liquidity. Like maybe you have cash, but you don't really have enough cash to grow. Even if you have cash, you have the reserve. There are ways to improve that cash flow, and then improving the accounts receivable, slowing down your payments to vendors to the extent that you can without being penalized, and then getting money in the door faster will really improve the cash flow of your business. And that gives you flexibility to invest more money in new equipment, invest more money in marketing, invest more money in adding additional headcount that then they can add more cash to the business, because you're going to hire, it's going to add to your business and not be a net negative. This improving of cash can add a lot of flexibility and a lot of growth opportunity to the business that you would not have if you didn't really have that cash in hand. And it can save you money too, in terms of, interest that you were borrowing cash. And if you improve your cash flow, you don't have to borrow, you don't have to pay interest. That's kind of a double win. These are strategies. I just kind of talked about them. Accelerate your receivables, give people incentives to either pay you more quickly or make a concerted effort to, send follow-up emails and say, here's a reminder, you haven't paid this PO. Get that done as part of your accounting. Goes out the door immediately. My dentist puts her bills on red paper, and I always see it. Like, because I think, oh my God, what's that? And then don't confuse it with junk mail. Like, how money in the door more quick expenses? And do you need to have, stuff you can money, which will really it's just staying on top of it. It's forecasting and daily monitoring. I think the forecasting is really critical. It helps you think, by spending on it should more, if I'm getting more out of it, when should I be doing that? From a cash flow perspective, do I need to, dial that down in the slow months? Like, why am I spending the same amount every month when there's not people here to be marketed cash flow, right? And they're like, okay, well, I know business A, for vendor A is going to ding me a lot of money if I don't pay that vendor right away, but vendor B, vendor A, and then when I get more money and I'll pay vendor, you want to be the one that knows that right. And then multiple income streams. Is there a way to diversify your cash in? It's again, seasonal businesses down here. Is there a way to mitigate that? If you're super slow, is there other type of business that's synergistic with what you're doing that isn't as impacted education, right? Is there any way to diversify your income streams just to reduce the risk of lowered sales for particularly weak and particularly bad weather, what have you, right? And then controlling your outflows, just digging a little deeper in terms of how can I cut those expenses to boost my cash flow. Optimizing, it can help you with projections and just make things much easier. Take advantage of accounting. You have good data to put into AI to create a better forecast. Take advantage of automated invoicing, and then build yourself a dashboard as like, I know that my marketing spend should never be more than X% of my sales, because it doesn't make sense, right? Or if my cash falls below a certain level that I'm comfortable with, then I need to take more drastic action and, cut my expenses. You need to kind of think through those things that make sense. Again, every business is different. Think through what are your key performance indicators, what things make sense to you. If you haven't booked, X amount of trips by the middle of the month, is that a concern where you're not on track to hit your revenue goal for that month, right? What do I need to do to make sure that I'm hitting those goals? And the earlier you get those warning signals through dashboards, through your forecasting tools, the better off you will be. And then you'll start moving to a proactive mindset and away from a reactive mindset. And your business will, and your mental state will be healthier for it. Your takeaways for today is your pattern isn't a problem. It's your roadmap. You need to look at, what does that look like for me? What does it look like for my old business? And I'd probably be surprised if you haven't dug into your prior financials. Clear patterns typically emerge pretty evidently. You can compare how your growth year over year. A lot of people will look like, oh, how am I doing versus last month? The real important thing is, how are you doing versus a year ago? Kind of be mindful of that pattern. It's your roadmap for planning ahead. Work hard on developing your 13-week forecast. Don't be daunted by it. It's not